then it goes over pretty much depreciation, amortization, stuff like that. So let's see where we got a cheat sheet. Where's the cheat sheet? Probably missed it. There it is. Okay, now these you're going to have to want to put to memory or figure out some way of remembering it. Because you don't have notes, right? So you're going to have to, this will be tested several different ways on the exam. So the really machinery is pretty easy because think about it, when you buy something from somebody, they're going to invoice you for the cost of the machine and usually the taxes and definitely transportation if they paid for it. And then you're going to look at, in this case, installation, assembly, and testing. So anything that goes into acquiring the equipment goes into the cost of the equipment. Okay. On a building, it gets a little building, land improvements, and then land. All these three things start to get a little tricky. So usually a building, right? If you buy a building, if you've ever gone through a closing process, they give you a full disclosure of all the taxes and fees that you paid in addition to the actual cost of the land. So you take the building, you take the cost of the building plus all those fees and taxes that you paid. That is part of the cost, right? And so that will go into your building costs. Of course, if you actually construct it from the ground up, you're going to look at not the land, because the land's right here, right? Almost think of it as a land improvement. The building, it sits on top of the land. Everything that goes into that building, the foundation, the electrical, the framing, the tile, the fixtures, everything associated with that building is going to go into it. And usually, they didn't really cover this, but also the interest that let's take you take a construction loan. Usually the interest will be included in here as well, but they're just covering insurance during construction, but not after it's complete. So that's the building, right? Then land improvements would be everything around it, right? So a parking lot would be separate because usually those are maintained separately from the actual building, right? And lighting, fencing, those are all separate asset groups. And so that would be a land improvement. And then you have your land. Now the land itself has to be prepared. So you've got usually you have to clear it out, you have to grade it, you have to get it in the condition that it can be used. And so anything associated with improving the land itself is covered in here. And let's see. Oh, I said if it's a lump sum purchase price, you have to figure out how to allocate it between the building and the land. If you paid $100,000, how do you split it between these two components? So always quite a trick to figure out what the land value really is. But usually they can figure that out based on like price per acre. To come up with this amount, usually your local, your government agency, the assessor usually has a value for the land. You can use that and then figure out what the difference between the land value is and the total price, and that's your building amount. Okay. Depreciation is the cost of allocating that asset expense or that cost over time. You have to remember your salvage value, your useful life. Now, anytime you make any adjustments, right, you have to double check your depreciation. So if you look at ethics assignment 2, the reason why I wanted to make sure that you figured out the depreciation expenses, because anytime you do an extraordinary repair, it increases the cost of the value, cost of the equipment. It often will expand or extend the useful life. And so you have to take those two factors into account, in addition to whatever you've accumulated in depreciation, come up with the actual remaining depreciation value. So if we go back here, right, in the example of the ethics exam, or the ethics assignment, you had a cost of the equipment of $2 million, right? Let's see what we can do here. I want to do that one there. Okay. So $2 million. And it was a useful life is 10 years, right? So right off the bat, and this one has no salvage value. Did it have salvage value? No, it didn't tell us the salvage value. I'm going to put in a salvage value. You can always take it out for the ethics assignment salvage value. Okay, let's say the salvage value is I don't know, $50,000. Okay, so right off the bat, your straight line depreciation is going to be your cost minus salvage value divided by your useful life. Let's put in little doodads here, parentheses. Okay, how did I come up with that? Oh, because I took out the salvage value. That's right. We'll make that 0 for now so you can see how this works. Okay, so then that was so in year 5 effectively they called year 10, but then there's an extra, let's see, extra, sorry, I'm thinking ordinary repair, okay, of $600,000 that extended life by 5 years. Okay, and this was completed we'll call it year 5. So what effectively ends up happening is you have to first figure out your net book value after repair. And you have to identify your remaining useful life. Okay, so the last one is probably the easiest. Remaining useful life is you take that original useful life minus the number of years that has been depreciated, oops, right there, plus the extension. Okay, that's all. Voila, you get back to 10. And the net book value is a little interesting because let's just put one thing in here. And actually, let's move this down. Completed. We're going to put it right there. Or insert here. Oops, entire row. And we're going to take this one out. Just give it a little more room. Okay. So with that, your accumulated depreciation is going to be the $200,000 you've done so far times the number of years that you've depreciated it, right? So that's $1 million. So your net book value after the repair is the original cost minus the accumulated depreciation plus the extraordinary repair, right? So you have $1,600,000 divided by 10. So your revised depreciation per year is the net book value divided by the remaining useful life. Now that's in a simple scenario. But let's say you had the $50,000 here. Okay, so this makes sense. You got the remaining, you have the straight line depreciation of 195. It changed the accumulated depreciation, but the net book value is a little bit, that net book value is the same, right? You take the cost minus the repair, minus the accumulated depreciation plus the repair. Okay. And that gives you your net book value. That's great. This is the same, but this is different. So I probably should have in the formula to make it a little bit easier to follow here is to minus the salvage value again. Okay, to figure out the revised value. and then divided by 10. So it's 157,500 if there's a $50,000 salvage value. If it's 0, then it takes it back to 160. See how that works? So no matter what, I can create something like this. And maybe it would be easier if I move things around a little bit. So let's cut this and insert here. And let's cut this and make it like, I don't know, here. Insert cut cells. Okay. So you completed the repair in year 5. It was for $600,000 and extended for 5 years, right? Your accumulated depreciation at this point is the $1 million, right? So something like this where you can just, create a quick kind of workout of the problem, plug in the numbers, and you've got all the values you need here. You have the accumulated depreciation, you have the revised depreciation, you have the net book value. You have a lot of different things going on here for you. Okay, that's set. Let's go back to our problem. Okay. So this should be straightforward, right? When you record depreciation, you debit the expense and you credit the accumulated depreciation amount. This one's temporary, right? It closes at the end of the year, goes back to 0. But this one accumulates over time. That's why it's called accumulated depreciation. 1 year adds to another year, adds to another year, and so forth. You got your straight line, which I've walked through. Your asset book value, I call it net book value, but it can also be called just your book value. Units of production, depreciation. This one, basic, same formula, except for instead of years, you're using units of production, and then you're just figuring out how many units were actually used for that period of time and times it by the depreciation per unit. Double declining balance. Remember, this does not take into account your salvage value. So like in this case, right, this number doesn't matter. What does matter is your useful life is 10, right? And so you take effectively 100% divided, equals 100% divided by 10, and then times 2, okay? That's your double declining value. So your first year depreciation is going to be first year is going to be your cost times that value, $400,000 instead of $200,000. But then you have to then apply this percentage to the beginning value for the next year. So I did a video on this as well. Make sure you review that and let me know if you have any questions. Okay. You always have that changes in estimates. We've gone over that. Change in book value because of repairs, change in revised salvage value because sometimes you won't be able to get, let's say, $50,000 for that piece of equipment in the long term. Maybe you only get 0. Maybe you actually have to pay somebody to get it off your land. So the salvage value will change over time, and your life may change over time. You may get to a point where you thought it was 10 years and all of a sudden things go bad, and it's really only a 3-year life. So you have to take a huge loss on it if you have to get rid of it. Impairment, that's really associated with the same thing. Ordinary repairs, remember those go directly to the income statement, not to the balance sheet. That's what this is the definition of those: betterments or extraordinary repairs. And then the problem that you did as a group in the presentations goes through this, partially depreciated sale or gain or loss on the gain or loss on sale of an asset or disposal of an asset. You've worked through this pretty well. And I've actually posted some of those presentations in my playlist. So you have direct access to those anytime you want. I'll have to go back through Canvas to get that. And I think, the only other thing is the intangibles. And this, you just really need to know what these things are, what a patent is, what a copyright is, what a franchise or license is, and you need to know what one of these are amortized, right? Now, patents can be amortized, copyrights can be amortized, franchises can be amortized, all right? Goodwill is not. Leasehold improvements can. So a lot of these can, but goodwill most certainly cannot. Okay. All right. And this is the journal entry for that. Very similar to depreciation, but instead of depreciation, it's amortization expense and accumulated amortization. All right. So hopefully that'll help out in preparation for this upcoming exam. Let me know if you have any questions. I hope you have a great rest of your week. Take care. Bye.